Okay, so this is going to be a very important video and an important note. We have just gotten word from the Fed that they're starting to unwind the balance sheet that they've basically been blowing up or increasing for the past, let's call it 9 to 10 years. And we need to be able to contextualize that because each time we've seen an unwind or an end of a QE program, we've seen a certain reaction in the market. It's also important to know that even though in the immediate term, this news just hit on September 20, 2017, we have not yet seen a reaction by, let's say, stock markets. We've seen a reaction in currency markets and the fixed income markets, because it does take fund managers some time to kind of contextualize this and make up a decision. Each time we've seen the end of one of these programs, there was a lag until stocks started to react. You know, I always say in here one of Mark Twain's quotes that history doesn't repeat itself, but it often rhymes. And so this is important. This is a very important message. Let me show you guys a chart that I just crafted that is really, really important to understand, because, you know, you can look at charts all you want, but unless you can contextualize things in the bigger picture, I think looking at charts is pretty much useless. Let's put some things in context and let me show you a very important chart so you can be prepared for what may be coming next.
So here's this chart that I just mentioned to you. And before we look at it a little bit more closely, let's understand that the Fed's balance sheet around now is somewhere around 4.5 trillion. That's trillion with a T, there's not a B. It's trillion. It's a very, very large balance sheet, mostly consisting of bonds and other things like that. What we have seen here, if you go back in time a little bit, we had various stimulus programs coming out of the financial crisis when the Fed basically embarked on these quantitative easing programs where they started buying bonds and other mortgage-backed securities and things like that over time. And so what happened here in, I want to say, March 2010, we actually had the end of QE1, and that actually led to a drop starting about a month later or so, which measured about, let's call it 17, 18, whatever percent in the S&P. Doesn't really matter exactly, but roughly thereabouts. And we had another QE program take place, and that one ended, I believe, in June 2011. Then the market dropped also about, let's call it 17, 18, 19, maybe even 20%. Then what started to happen, and this is probably more recent in some people's memory, start to see the Fed basically start to embark on its interest rate hiking path, which it started to telegraph at some point around the September mark of 2015, and it finally actually ended up hiking rates in December. Well, guess what? The market didn't start dropping until January 2016, so again, about a month or so later, roughly speaking. Point is, the market then dropped about 15%. Okay, very swiftly. So the question now is, again, using Mark Twain's quote that history doesn't repeat, but it does often rhyme. The question is, are we going to see some sort of a similar reaction once the Fed starts to begin to unwind the balance sheet? A lot of this is going to be basically, rolling off of maturities, like not reinvesting bonds that mature. The question is, are we going to see some sort of similar move like that in the S&P take place sooner rather than later, given the fact that we've seen pretty much the same reaction here, here, and here? Let's take the base case of a 15% pullback that gets us to about 2120 or so in the S&P, which would be a nice retest of what used to be previous resistance. If we go a little bit deeper and we see the S&P drop something like 20 or so percent, we get us to about the 2000 area, which I think that too would be fairly normal, and call it roughly 2120, 2100 even, and maybe as low as 2000 would be a very normal pullback in the S&P. Again, I'm not calling doom and gloom here. I'm simply showing you guys a chart with some historical perspective, and now that we have more news out of the Fed, I do think that this is a very important. Again, you can look charts and chase charts all you want, but unless you're able to contextualize this with some bigger picture backdrop, over time it's very difficult to make money in the market. So the next question then, of course, is how do we start seeing when the market may start to fall apart? Well, what we're going to be using for sure, and I've been using this with Clubhouse members, is our short, medium, and longer term scanners, which is our proprietary scanner, and it allows us to measure when something is near-term bullish, near-term bearish, medium-term bullish, medium-term bearish, and the same thing for the long term. So right now, as you can see, pretty much everything is short-term bullish, except for utilities, which just recently turned near-term bearish. We're going to be looking for more and more of these parts of the market to start turning near-term neutral first, and then turning up on the near-term bearish scanners. That's how we measure this. If you guys are interested in this, either join us in the Clubhouse or leave a comment down below, and I will respond to you and show you how you can gain access to these scanners.